Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world one filing at a time. Today we are diving into a report from ContextLogic Inc., also known as Wish. It looks like they've entered a rather interesting agreement, which might make you wish you had their money. The report we're looking at is from early March, so pretty recent news. The main story here is about an investment deal and some changes to the company's leadership. Let's break it down. First up, we have what's called a material definitive agreement. In simple words, this means they've made a big deal that's officially on paper. Specifically, it's an amended and restated investment agreement, or A&R investment agreement. Think of it as a revised version of a previous agreement with BCP Special Opportunities Fund III Originations LP, an investor. This agreement involves the investor buying up to $150 million worth of something called Class A convertible preferred units. These are basically special shares that can be converted into regular shares later on. The deal started with an initial closing where the investor bought half of those preferred units, worth $75 million. There's a possibility they might buy the other half later, especially if Wish decides to acquire another company or assets. The company plans to use the money to acquire, meaning buy assets or another business, so they are gearing up for an acquisition. Now, these preferred units have special rules attached to them, all laid out in a document called the Amended and Restated Limited Liability Company Agreement, or A&R LLCA for short. These units give the investor a guaranteed return, like interest. It's 4% per year before any acquisition happens, and then it jumps to 8% afterwards. That's a pretty sweet deal for the investor. The investor can also convert these preferred units into regular shares called common units at a set ratio. After 5 years following an acquisition, Wish can buy back these preferred units from the investor. However, if Wish doesn't make any acquisitions within 2 years, the investor can force Wish to buy back the preferred units. So there's pressure on Wish to find a good deal soon. This deal also comes with some influence on Wish's board of directors. The investor gets a say in who sits on the board, especially if they own a significant chunk of the company. Before this deal, Wish put around $141 million into holdings and promised another $5 million later in the year in April and September. Moving on, let's talk about changes in leadership. This part of the report discusses who's in charge. 2 new directors, Ted Goldthorpe and Mark Ward, have been appointed to the board. Mr. Goldthorpe will even serve as the chairman. These new directors are joining important committees like the Compensation Committee, which decides how much executives get paid, and the Nominating and Corporate Governance Committee, which focuses on company leadership. They've also created a special Transformation Committee to oversee changes within the company. The board is divided into classes, with directors serving different terms. It looks like they want to make sure they have experienced board members for the near future. Ted Goldthorpe comes from BC Partners, where he's a partner running their credit division. He has a lot of experience in finance. Mark Ward is also from BC Partners, working on their credit team. These new directors will get paid according to Wish's standard compensation program for outside directors. There's also news about the CEO, Rishi Bajaj. He has a new employment agreement, including a revised pay package. Mr. Bajaj will continue as CEO with a base salary of $550,000 a year, with a potential bonus on top of that. He's also getting a bunch of Class P units in holdings, which are tied to how well he performs as CEO. These units vest, meaning he gets full ownership of them over time as long as he stays with the company and hits certain goals. If Mr. Bajaj leaves the company due to death or disability, he'll get certain benefits, including immediate vesting of some of those Class P units. If Wish fires him without a good reason, or if he quits for a good reason, he'll also get some of those units, again, depending on how well the company is doing. Of course, to get these benefits, Mr. Bajaj has to sign a standard agreement releasing Wish from any future claims. Now, what does all this mean? Wish is bringing in new investors and shaking up its leadership. The investment from BCP Special Opportunities Fund gives them a big chunk of cash to potentially acquire new assets or an entire business. This is a clear sign that Wish is looking to grow and expand its reach. But they have to do it within a relatively short time frame, or the investors can force them to buy back those preferred units. The appointment of Ted Goldthorpe and Mark Ward to the board, especially with Goldthorpe as chairman, suggests a desire for stronger financial guidance and strategic oversight. Their experience with BC partners could be valuable as Wish navigates its future. As for CEO Rishi Bajaj, his new employment agreement and the Class P units show that his compensation is heavily tied to the company's performance. If he can lead Wish to success, he'll be handsomely rewarded. Overall, this report paints a picture of a company in transition. They have fresh capital, new leadership, and a clear goal of growth through acquisitions. The pressure is on to find the right opportunities and deliver results. Is Wish poised for a comeback? It's hard to say for sure. The online retail market is competitive. But with this new investment and leadership, they have a chance to turn things around. What do you think? Thanks for watching. If you found this corporate decoder helpful, please like, comment, and subscribe for more insights into the world of business.